I used to invest in the stock market, but I stopped and switched over to index funds. I'll tell you why. Even if you become really good at finding undervalued companies, a few things happen that take you out of the game. First, even if you have a great business, 99.99% of them go through a growth phase, a peak phase, a decline, and then death. So not only do you have to pick a good entry, you also have to pick a good exit, because some declines can last for decades, and no one wants to lose money for decades. Second, even with a fantastic business, they often get taken out because of an acquisition or merger. I experienced this firsthand with King Will Production that got eaten by CBS and then Viacom, Oakley that got taken out by Luxottica, and Marvel that got taken out by Disney. With the Lofi US Index, companies that fail are replaced with successful companies. Companies that merge have no impact on my returns. I also don't need to worry about an entry point or an exit point. I just invest consistently, and during downturns, I deploy my opportunity fund. If you enjoyed this content, like the video, click on my bio to get my free guide. Take care.
Here's why you should reconsider investing only in index funds. Index fund gurus say investing in individual stocks is gambling. I say investing in individual stocks is only gambling if you're blindly picking assets based on hype and FOMO. Index fund gurus say, why not invest in the whole market? I say because only a handful of stocks in the whole market are responsible for the whole market's overall growth year after year. The rest of them are basically shit. What if I told you finding those long-term growth value assets isn't as hard as you think? What if I told you in my own portfolio I've been seeing a lot higher gains than the overall market average year after year? What if I told you I can teach you exactly how you can do this too for free? Link is in my bio.
Hey guys, Freelanceberg here, and I'm going to show you real quick why you're better off investing in index funds than trying to pick stocks. If you didn't already know, an index fund is a mutual fund or an ETF that tracks the performance of a certain index, such as the S&P 500. The reason you might be better off investing in index funds rather than picking stocks is because 95% of financial professionals can't beat the market. In fact, over a 15-year period, 92% of large cap managers, 95% of mid cap managers, and 97% of small cap managers failed to outperform the market. Which means that 1 in 13 large cap managers, 1 in 21 mid cap managers, and 1 in 43 small cap managers were able to outperform the market. In other words, only 3 out of 77 people in this study were able to outperform the market. So just by putting your money in an index fund, you'll be able to outperform 92% of the professionals. And one of the best parts is investing in index funds takes a minute amount of time and knowledge.
IRA on one of these platforms and invest into index ETFs like these.
So there's some pros and cons with investing in index ETFs. It's called an index ETF because it tracks an index, whether it's the S&P 500, the NASDAQ, or the Dow Jones. Now with an index ETF, you are guaranteed to get a market rate of return because it tracks an index or it tracks the market. If you're okay with getting the market rate of return, or you just simply don't want to do the research and take the time to invest in individual stocks, or you don't want to take the risk of investing in individual stocks, an index ETF is good for you. However, if you're like a lot of us, you want to beat the market, you want to get a higher rate of return than the market, you won't get that with an ETF. You're better off picking individual stocks, just whatever is comfortable for you.
What is the difference between stocks and index funds? When you buy shares of stock in individual businesses, you become a part owner of the business. That makes sense. For example, if you bought £100 worth of Apple shares, then you technically become a part owner of the company. And what about index funds? When you buy an index fund, you're buying a basket of stocks which are designed to track a certain index, such as the S&P 500. Okay. So if you buy an index fund, you own a share of stock for dozen, 100 or even 1,000 different companies indirectly. Which one should I invest in? Only you and your financial planner can decide which approach is best for you and most appropriate for your situation. But which one's better? As a general rule, index fund investing is better than investing in individual stocks because it lowers the risk and the need of constantly studying charts and reports for individual businesses. Man, I'm gonna follow you right now to learn more things like this.
Hi guys, so I wanted to share with you guys the difference between index investing and individual stock picking. So index investing wise, you are investing, for example, in an ETF, and this is when you invest in a broad diversified basket of assets. So you are basically investing into like hundreds of stocks at one time, so you can only expect average market returns. While if you do individual stock picking, then you are basically cherry picking stocks that are outperforming, and hence those stocks will gain you greater returns. Of course, it takes more effort because you have to do in-depth research into each company and things like that, but it's definitely worth it in my opinion, and it's something that I've been doing as well. So yeah, hopefully that gives you guys a clear explanation as to which one might fit you more, and feel free to ask me any more questions in the comments. I'll be happy to help you guys, and also follow me for more investing tips.
using index funds versus individual stocks. Most of my portfolio are index funds. And I have to tell you, the longer that I invest in individual stocks, I don't like it. Super stressful. They're very volatile. I mean, crazy volatile. I've had some stocks fall like 15, 20% in one day, right? The stock market doesn't do that unless it's a crash. But for one individual stock to fall 10, 15, 20, 30% in a day, that's normal, right? That's not called a crash. When you're adding individual stocks to your portfolio, you have to admit to yourself, hey, I am increasing my risk because I want an even bigger return than index funds are going to give me, and I want it faster. And there's no guarantee that that's going to happen.
Hey guys, Jim in Toronto, you need to stop investing in individual stocks. Every generation seems to have this scab of individual stocks. Everyone feels the need to pick it. Despite the fact that studies everywhere show that 95% of active investors fail to beat an S&P 500 US stock index. What are you guys doing? Imagine sitting on your ass, not even studying for your GRE, LSAT, MCAT, whatever, and still scoring in the 99th percentile without picking up a book. And that studying may actually result in a lower score. Why would you do this? Just have the 500 biggest companies in America working for you and spend your time doing something else. Take care.
Time. 96% of mutual funds will not even match the market. They've all said it. Warren Buffett flat out said today, he said, listen, in my will, 90% of my money, all that money does not go with any mutual fund, it goes straight into the index. What the index is you get a piece of all the largest companies in the world, but it costs almost nothing to get in. You hire someone because you say, I have a family, I have a business, I have a life, I'm not an investor. I'm gonna hire someone who's a professional. It makes sense, they would do better than me. Unfortunately, that's wrong. 4% of them will beat the market. 4% chance to find the right mutual fund. It's not gonna happen.
Stock market approach is the stock market approach that Warren Buffett, the world's best active investor, recommends for most investors.
So this time I went back actually to 1942 when I bought my first stock as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it'd amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776. And that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America worked.
Okay, in this video, I'm going to talk about the difference between indexing and picking individual stocks. So me personally, I like to pick individual stocks because I want to invest in the best of the best companies that I know and understand in and I believe in and I want to support. So that's the way I do it, because I also understand how to read the financial statements, like the cash flow statement, income statement, and the balance sheet. So that helps me understand the companies and really dig into the financials to understand what I'm investing in. So that's me personally. Everybody's a little bit different on how they should handle this. Warren Buffett, he basically just says most people should just index. It's easier, it's simpler for them to do that. Now, he does pick individual stocks, and there are other famous investors that like individual stocks, but again, he suggests for the average person just to index. And Jack Bogle, he's the creator of Vanguard, and he's one of the founding fathers of indexing. So he's all on board with indexing, and it makes a lot of sense, right? These guys, when you buy an index, you can pretty much beat 80% or more of the fund managers out there, and you have very low fees. So I would agree with them. Indexing is good for most people. you are guaranteed to get the market returns, and with indexing, and you don't have to do really any research, right? So you can just invest, you know, maybe dollar cost average into it over time, and then you're good to go. You can go enjoy your life and go enjoy the things you like to do. Okay, so again, I like to pick my own stocks. That's what I like to do. But hopefully this information will, you know, it gives you another options to look at, and you can look at it from different angles and pick what's best for you. Okay, so if you guys like this information, if you want to see more videos, please subscribe. I'd really appreciate that, and we'll see you on the next video.